Today we are going to be discussing why timing the market feels right but fails. And the reason being is that when you try to time the markets, your emotions are the opposite of what would be allowing you to be successful. And that is being that when things are high, you're most exuberant, you're most excited to invest in the markets. You are then wanting to invest, you're then wanting to put maybe larger percentages of money than you would be willing if things were low, if there was a crash. But in reality, when things are high, that's when you're experiencing the most risk. That's when you're vulnerable. And in those times, you need to avoid that sort of thing. You need to avoid this sort of exuberant trading that goes on in bull markets at highs. When you are investing huge sums, larger percentages of your money, well, not necessarily you, but on average, that's when that's happening. Large speculative trading is at the highs when the craziest risk happens. And that's why we've seen traders, especially in leveraged positions in, say, assets that can be highly leveraged, like crypto, for instance, in tech stocks. You see traders take leveraged positions and then the market goes against them. There's a large sell-off, like especially what we saw with crypto, I'd say the end of the year last year, right? We saw a crazy sell-off in Bitcoin. We saw a large amount of liquidity just vanquished, right? And Bitcoin just crashed. Everyone there was like, woof, gone, money gone, and people that had highly leveraged positions were liquidated. And some people even, unfortunately, resorted to taking their own life. And, not a good thing, obviously. And the fact is, they were exuberant. They were trying to make a lot of money. And in reality, they were most at risk. Bitcoin was at all-time highs and then steeply declined out of nowhere, boom, vanquished. And people were like, whew. Not entirely but there was large portions of liquidity wiped out at once, and it fell in large chunks over the months, and it was scary for a lot of people. But long-term average, dollar cost averaging with a long-term view, little bit different in asset classes. Rather than having crazy amounts of leverage, 100x leverage, and those people, they were essentially trying to time the market, and they were trying to make crazy amounts of wealth in a very rapid time, but they actually did the opposite. They lost crazy amounts of money. So, why timing the market feels right but fails? So, the number one thing is your emotions. When you are trying to time the market, your emotions take over. And when we're at exuberant highs, you're most likely to put in large positions, crazy big positions, maybe too much of your overall equity. And when we are at lows, right? When we are getting crushed, when everyone is panicking, everyone you see is talking about, oh, the stock market's doing so terribly, the 401ks are down, the trading account is down, their whatever they have, their NFTs, their crypto, their even gold, a lot of times not inversely correlated to the markets as one would think. Anyways, your portfolios are down, right? During that time, and you're not inclined to invest, right? But in reality, the market goes down, it is on sale. At that time, the market is actually cheap, right? It's on sale. When it went down, it's on sale, but everyone around you is saying you're crazy, right? Everyone around you is saying it's done. This is the market crash to be all crashes. And historically, in societies, majority of people think it's the end of the world, think it's the market is crashing, are generally bearish, right? They're generally bearish people. And that can be good, right? To be risk averse, to want to protect your capital. But overall, like we said, in the markets, you need to be invested in the market average for the long term to outperform cash, because holding that cash is always going to erode, right? You're going to be a victim of inflation. Your money is going to go down over time. So, when you are trying to time the markets, your dollar cost averaging into the markets over time, so much so, someone could ask you about the market, you're going to be like, I don't care, right? You don't even care about the market at that point, because your dollar cost averaging systematically into a few choice assets, and over time, you're expected a positive return. And you're not really concerned about the month to month, even the year to year, because you're just so locked in. It's almost robotic. And that wealth is building, compounding over time. You're getting to new highs. So, timing. Very hard, right? It's very hard to time the markets. It's almost impossible. But why timing the market feels right but fails, how can we try to get an advantage here, right? So with our enterprising amount, how can we get an advantage? Because generally, we want to do what's best for the majority of our portfolio, right? We know majority of the time that in our enterprising portfolio, we're going to fail. Majority of your enterprising investments, your investment ideas are going to fail unless you become exceptional. So, when can we give in that chance, that portion of our money, a chance to time the markets? It's when it is on sale and is with a margin of safety. We want to invest with a margin of safety in our enterprising portion of our portfolio. And with that amount, we want to buy when it is on sale, being that, for instance, if you have something and say it's 3 parts, and of those 3 parts, you bought at a whole 3 parts, and you have 5 total. That is equal to 1.5. But say you have five parts total equal to 2.6 times 5. Oof. So 1.21, is 1. So 33% less. You got it at a sale. You got it cheap. At that time, it's cheap. But now calculate out the all-time highs, right? That 3 of 3, that's your all-time highs. 5 pieces times your all-time highs is 1.5. It's not on sale at that time. but you're 2.3, or sometimes assets go even lower than a third off. They go half off, right? Especially in some of the Mag 7 resilient stocks. Maybe, for instance, you see something that is sold off heavily, right? You know it has a lot of cash. You know it has technology that is somewhat monopolistic. It's going to be around for a long, long time. And hey, invest at your own risk, you know? That might be a sale at that particular point. Hint. Anyways, at that time, it is on sale. Timing, very hard. Don't do it with the majority of your portfolio, just with your enterprising amount. And lastly, discipline. Right? Discipline. It's very hard. It is very, very hard in these times to time the market. And remember that. So, in conclusion, that is why timing the market feels right but fails.